If you've ever wondered what data to track, how to analyze your data, and how to apply math to your trading, this is for you. So tracking and analyzing your data is not only necessary, but one of the best pathways to improve your system and trading consistency. I will go over some points with some data examples. Then at the end, I will show my own spreadsheet, something many hide behind a paywall, but I find no issue sharing for free to hopefully provide some value to you on your trading journey. So you can do this in paid services, track trading data. You can do this in paid services such as TradeZella, or you can do it how I do it for free in a Google Sheet. I recommend the latter because it is free and allows for infinite customizability of data being tracked. Don't be lazy, don't be scared of doing the manual work. So the concepts I'll be covering today are: why do you need to track data? What data needs to be tracked? How do you analyze this data? What do you calculate with this data? And some extra trading math to know. For why do you need to track data, I'll be going over verifying your edge, deriving valuable insights, being aware, and why the more data, the better. For what data needs to be tracked, I will go over all these points. How do you analyze this data? What do you calculate with this data? I'll go over averages that you should be tracking, how to calculate your edge, aka the holy grail of trading, right? Your edge, your advantage over the market. Point number 3, edge optimizing math. So there's some math that you can use to optimize your edge after you understand it more. Point number 4, risk profile. The risk profile that comes with your data. And some extra trading math to know. 1, building in failure, which is very important. 2, your personal bell curve. 3, capturing positive statistical variance, reducing negative variance. 4, inverse correlation to expectancy. 5, Kelly criterion / optimal growth factor. 6, parabolic RR. So those are more advanced trading math concepts, but they are very interesting and very valuable, and I didn't want to leave them out of this video. So point number 1, why do you need to track data? Well, 1, to verify your edge. Why does a business need to track its data, its profit and loss or margin or inventory? How would a business perform that didn't know their margin, inventory costs, or profit and loss? Horribly. It would, a kid with a lemonade stand would perform better, right? So step 1 to having an edge is verifying your edge through data. 2, to derive valuable insights to further understand your edge and enhance your edge. So if I track my stop loss percentage, and every time I trade a certain stop loss percentage I am stopped out, then I learn to not enter that stop loss percentage. Not from anecdotal data, but from statistical data. Learning and enhancing your edge, right? So point number 3, to be aware. When you track your data around your strategy, you become aware when things are shifting. If your recent win rate percentage is plummeting, it's hard to argue that things are working. 4, the more data, the better. The more chances to learn and more patterns to recognize. So next point, what data needs to be tracked? Percentage gain, percentage loss, win rate, percentage stop, risk to reward, capital gain / loss percentage, exposure, trade duration, monthly data. Now, all of this is important on its own, and as very beneficial to the entire data picture. And it doesn't take much hair off your back. This is really the basic things that you should be tracking constantly to even consider yourself one notch above amateur. If you're not tracking these things, it's similar to the business that doesn't know its profit and loss, its margin, its inventory, etc. You don't even know what your business is, right? You need to treat it like a business. Excuse me, sorry. So what do you calculate with this data? Averages. So you can deduce averages from all of the data points that I just pointed out, right? Your average trade duration, your average exposure, etc., etc. To put simply, if you know your average win, you know where to sell. If you know your average loss, you know to avoid larger losses than that. If you know your win rate, you know how much to risk or size. Now, all combined, you know your edge or expectancy. So there's a lot to learn from your averages and a lot of valuable insights to deduce from your averages that you can use for your actions. But for point number two, you need to track at least those 3 points to know your edge. So expectancy is your win rate times your average win minus your loss rate times average loss. So for me, 31.47% times 0.63% minus et cetera, et cetera. So you get, 0.2% practically minus 0.12% equals, 0.07% capital gain expectancy per trade. So based on this data, I have a positive expectancy per trade, right? So the more you can turn over that positive expectancy from your system, the more you can make. Now, obviously, not every trade you enter, you make 0.07%, and then you never enter a losing trade. Now, this is just informative data to see how strong your edge is, right? How strong your expectancy is. So point number three, edge optimizing math. If you know your win rate and average risk to reward, you can deduce your mathematical optimal sizing using Kelly criterion or optimal growth factor formulas. So if you know your win rate percentage under certain stop percentages, you can either cut out those percentages or enter them more. There's a concept known as parabolic RR, which I will cover later on. But basically, if you can maintain a reasonable win rate with a tighter stop loss, it is likely better. For me, under 2% stop loss, I have a 4% win rate, so it's not plausible. So if you know the average R peak of your positions prior to you selling, you can perhaps derive a valuable insight such as taking more profits, moving stops break even at a certain point, or other actions to optimize your edge, right? So if you see that a lot of the time your trades peak at 5R, but you only return 2R, you're going to, like I said, you're going to derive a valuable insight such as, I should take profit at 5R. I need to capture that 5R, right? So point number four is risk profile. If you know your win rate, you can derive your potential losing streak or potential worst case scenario losing streak from statistics. Then you can understand how to act under a losing streak / drawdown to mitigate, your drawdown and survive. So here I will show an example of some math around a 1000x trade sample simulation, if you will. So if you have a 65% win rate, you only need a 0.54 risk to reward ratio on average to break even. And another point is across 1,000 trades, you have across 1,000 trades, it is guaranteed that you will go on a 7-loss streak. Maybe not guaranteed, but at least it's very statistically probable, right? Statistics points towards it as true. So 60% win rate, it goes to, as you can see, the break even risk to reward, increases, and the loss streak also increases. So if you go all the way down to, let's say, a 20% win rate, you have to get 4R to break even. And it's very likely that across a 1000x sample size, you'll go on a 30 trade losing streak, right? So you can, use this to your advantage. If you are a 20% win rate trader and you have the chance of going on a 30 losing streak, you can learn how to size down as you're entering a losing period. Now, something very interesting is one of the US Investing Championship highest performers actually did go on a 30 losing streak in the middle of his best performance ever. But he entered a very, marginal, a very small drawdown that was, he was easily able to escape after he entered a winning streak, right? And then he scaled up his sizing. So moving on to extra trading math to know. Point one, building in failure. So the lower your win rate The lower your win rate is while you maintain a positive edge or expectancy, the more failure you have built in. So if you have an 80% win rate system, but your risk to reward is 0.5, so very small, right? Um, you're risking, let's say 10% and your return is 5%, right? That would be a 0.5. Um, so in 10 trades in positive conditions, you would make 28%, or you could make 28%, right? But in poor conditions with your edge cut in half, your win rate, drops to 40%. You are then quickly down 50%, minus 50% drawdown. So this system would not have failure built in and could possibly just quickly destroy capital in poor conditions, which are certain to come eventually, right? You can never just dodge poor conditions forever. That's it's not going to happen. That's a fairy tale scenario, right? So you have to prepare for the worst case scenario. On the other hand, if you had a 40% win rate system with a risk reward of 3R, if poor conditions came and your edge was cut in half, now you only have, let's say, a risk reward of 1.5R, you would result in a mere 2% loss across 10 trades, right? So this is the concept of building in failure within your system. You don't want to enter a potential losing streak. Like I was showing you, it's, you can enter losing streaks. It's probable that you'll enter losing streaks across a long enough period of time, right? So when that losing streak comes, you get absolutely smoked, you're down 50% and it's very, very hard to recover. You've, possibly negated years of performance, then that's very bad, right? That's very bad. So point number 2, personal bell curve. You want a skewed bell curve with a strong wall on your bottom end and strong peaks on your top end. So below is an example, a chart of my own data. So notice the hard wall at 10%, right? Most of my trades are under 5% loss, but you can see there's a hard wall at 10%. So I have no trades exceeding that amount. Now, you can rarely get gap down on. You could get gap down 20%, 30% on a stock on some really bad news, but I don't trade into earnings and I haven't been hit with a random news event. It's very rare that something like that would happen, but it is out of your control. So of course, manage what is within your control. If you want to see a vast majority below the wall, right? You could, it's unfortunate if a news event gaps down and, one slips past the 10% wall, but that happens. That's not within your control. You manage what's within your control, right? So point number 3, capture positive statistical variance, reduce negative variance. So let's say you have an average win of 2R. If you have a trade that is at 2.5R or 3R, that's positive variance that you can capture to increase your average. Now, the more variance, the higher you will increase your average. So you want to simultaneously guarantee you will capture some positive variance, right? You don't want to let all the positive variance slip away, but also allow for yourself to capture as much as possible. So up here, my trades returning more than 30% are the perfect example. They were vastly above average, and therefore enhanced my system when the variance was secured. So when I allowed for them to move, instead of 10%, I allowed for them to move 20%, 30%, 40%. It allowed for my system to capture a lot of positive, expectancy, right? A lot of profit, right? It added value to the math of my system. So point number 4 is inverse correlation to expectancy. Give me a second to drink some water. Sorry. So the higher risk to reward you have, the lower win rate you will have. This is an inherent law of probability. Though not precisely predictable, it will always be true, right? A 50 risk to reward is rarer than a 25 risk to reward, and 25 is rarer than 10. 10's rarer than 5. 5 is rarer than 1, etc., right? This is it's just kind of inherently true, right? But any risk to reward can be wildly profitable if your edge is positive, right? So it comes back to the expectancy formula. You could, win 5% of the time. You could win 20% of the time. You could win 30% of the time. Like I do, I have a 30% win rate around and have a positive expectancy in your trading system, right? A positive edge. Excuse me. So point number 5, Kelly criterion / optimal growth factor. Once you know your win rate percentage and risk to reward, you can run these formulas to deduce your mathematical optimal sizing for growth. Now, something crucial to understand is this does not mean you trade at this size all the time, but only when your edge is truly apparent, because it will yield the most return to trade at that size. So my optimal sizing is 33%, but if I were to enter 33% sizing consistently, even while my edge is not apparent, I would quickly enter a heavy drawdown, right? If I have 33% sizing and I have a 4% stop loss, man, that'll be a 1.3% drawdown each trade. I'd get smoked pretty quick. Referring to the losing streak math, right? With a 30% win rate, there's a chance I go on a 19 losing streak. I've gotten near this, honestly. I've gotten near 19 losing streak. So if I was losing 1.3% per trade 19 times in a row, boom, you're smoked. You're getting smoked, right? You're down way more than you'd ever want to be down. So my point with this is your optimal sizing is not your constant sizing, but instead the sizing you work towards while conditions are optimal as well. So progressive exposure is key. Point number 6, and the final point, is parabolic RR. Now, parabolic RR is the concept of risk to reward increasing parabolically when stop loss percentage is tightened, showing an asymmetric relationship. Now, mathematically, I don't think this is actually parabolic. I think it's technically hyperbolic, but the point is that reducing stop loss 50% increases risk to reward by 100%. The potential for expectancy increase from this, right, the edge optimization from this, comes from whether or not your win rate percentage decreases. So as you decrease your stop loss percentage, if your win rate percentage is the same or doesn't change drastically from 3% to 1.5% stop losses, you can enter tighter stop losses and improve expectancy. But in my opinion, you need a lot of data points to apply this math to your system. Don't just willy-nilly try to enter tight stop losses because of this concept. So this is the chart showing how I was saying changing your stop loss from 3% to 1.5%. As you can see, the marker here is 3% and the marker here is 1.5%. And in each instance, so on the 25% return, you can see 3% stop loss, you have 8.33 R, and 1.5% stop loss, you have 16.67% R. So the math is pretty consistent, but what's important is you understand your math around it. So this would be my own math around this potential edge increase. As you can see, stop loss under 2%, I only have a 7% win rate, right? So I stay far away from that. And the net growth on that is minus 4%. I stay far away from that. And as you can see, here are the win rate percentages and the net growth for my other stop loss ranges. So under 3%, it's about net break even, right? It's a small, it's about break even. These are the trades that keep you afloat, keep you going. And then above 3% win rate, you can see is where the real kind of edge is for me from this kind of math I did for, I think I had about 130 data points for this math. So 130 trades, which I had gathered data for. So now I'll be going over my spreadsheet. Okay, I'll be going over the layout of my spreadsheet. I'll just be going over a quick overview of what I track, some formulas that I use in my spreadsheet, some charts that I have in my spreadsheet. I'll show my monthly panel and I'll show my yearly panel. So let me fix that real quick. So as you can see, here is my spreadsheet. I'll go to the top real quick. Instantly, you see a lot of numbers, a lot of data, a lot of columns, a lot of stuff, okay? So I'm going to try to isolate it a bit. Here is the data I track as soon as I enter a trade, okay? I'll put in the date, the time of entry, the stock, the price I bought at, my stop loss percentage. This is very important. Sorry, you need to track your stop loss percentage. Target percentage is not as necessary, okay? There's not much data you derive from your target percentage, quite frankly. Entry capital percentage. Now, this is very important, right? Is how much capital you're entering for each trade. Is it 5%? Is it 10%? Is it 33%? Is it 5%? Is it 2%? Is it 1%? Et cetera, et cetera. Total position capital. Now, this is if I had previously bought a position and I'm adding to it. So maybe that specific entry had 5%, but it's adding on to the position and now it's 10%. So that would be total. And capital risk, right? So that would be the capital percentage and the stop loss percentage. And you get your capital risk percentage. And then total capital risk percentage, right? So as you can see, when I entered this second trade and I had 0.61% capital risk combined, since these trades were both concurrent, I had 1% total capital risk prevalent. So that is the data that I track as I enter the trade. Now, when I close the trade, I track this portion of data. You know, the date closed, the realized risk to reward, the trade gain percentage, capital gain percentage, trade loss percentage, capital loss percentage, realized dollar sum, which I won't be showing any dollar sums for this video, and the win/loss column, which is just, you know, a column to quickly see whether or not it was a win/loss. So that's the data I track at the close. Now, here is some fun extra data that I track. Here are some formulas. I have my P&L realized formula in the top left here. So it's the sum of, you know, capital gain percentage and capital loss percentage. And then I have my win rate percentage formula, which is basically just wins above 0.1 R. I have my win rate past 15 formula. I have my break-even rate formula and my loss rate formula. And each of these are rolling formulas. Now, I'm not a spreadsheet genius whatsoever. I made all of these formulas using AI, and I advise you do the same. And many of the best traders who have made millions and millions and millions use AI to help them track their data. So I'd advise you do that. Obviously, you know, don't use AI to track your data, but use AI to make formulas. I don't know how to make spreadsheet formulas, but I'll tell you what, AI is really good at it, and will tell you instantly. So here's, so that's that data panel. This data panel is very, very helpful and very interesting. Moving on, I have my mean, median, and mode data panel where I track my stop percentage, capital risk, target, which is kind of blah, like I was saying, it's kind of like nonsense, honestly. Now this is the juice, right? Average percentage loss, average percentage gain, and then also mode is just a fun one, right? Mode is kind of like a curiosity sake. Average capital gain, average capital loss, average trade duration, average entry size, average concurrent exposure to the market, right? Average winner duration, average loser duration, average break-even duration, total trades, winning trades, losing trades, break-even trades, yada yada. So that's enough for the formulas for now. Moving on is the charts. So once you have all of these data points, right, from, you know, column A to W or whatever, or A to AA, you can make charts based off of this data, which is one of my favorite ways to interpret my data, right? So for the RR dot scatter chart, you can see that You know, the majority of my trades are under 5R, but occasionally, you know, I can capture some way beyond that, right? And then also you can see the majority of my stop losses are -1R, but occasionally, you know, you'll have a gap down or some, you know, freak slippage situation or something like that, right? Similar thing with the RR histogram. And then here's a fun one, right? Is the win rate past 15 trades. This is one of my favorite ones that really gives you a perspective of how the trading has been recently. When trading is going horribly, which has happened over the past 6 months, we've had some pretty negative conditions occasionally. I will have a 6.67% win rate across the past 15 trades, right? So like 1 out of 15, horrible. Um, but as it ramps up, it gives you the indication, oh, market's improving, my system is performing better. Time to increase my sizing, increase my risk. So this is one of those data points that you can use to derive valuable insights to create actions off of. So here's my win rate percentage. As you can see, as I started tracking my data around May, my system was doing very well. I was faced with a strong winning streak, right? In my past 15, it was at 60%. Sorry, I'm speaking a little too quick here. So as you can see, as my system went on, and we were also in some pretty negative markets for a sustained period, my win rate percentage dropped, you know, with my P&L percentage, although not drastically, right? So even though across this period, as you can see, I was consistently losing, my P&L percentage only went from 11% to, you know, peak to trough, 11% to 7%. So about a 4% peak to trough drawdown in, you know, very hostile markets. Now this is done through sizing based on, you know, using this data for insights, right? You go, oh, my win rate percentage is plummeted. I need to reduce my sizing and just be patient, you know, reduce my risk, right? So here are some more fun charts, you know, R realized, so kind of like P&L, but much different. So here's a fun one. You can see from here to here, my R has dropped 20 points very quickly, but due to my small sizing, that 20 R was only, you know, -2% or so. Equity P&L. Now this chart's a little off. I don't have my data points are a little off for this chart. They're all on a different spreadsheet. But here's a fun one. SL percentage, right? You can see that I very rarely do a stop loss percentage, you know, past 8% or 8%, and generally keep under 5%, right? Month P&L, you can see how you're performing month to month. So I've had some, you know, pretty flat months, some pretty strong months, some negative months, et cetera, et cetera. And here is trade percentage gain loss, which I had in my Google Doc. So next I'll be showing my monthly data. Okay, so I'll be showing my monthly data panels, how I kind of review my month data wise. So this is my data tracking. Okay, I think you should do thought tracking and chart tracking as well, right? So I think you should track your thoughts around each of your trades, and I also think you should track your charts around each of your trades. So this is only one facet of your quote unquote tracking or trade journaling or, you know, whatever, right? So monthly data. Here's May, for example. I have my R return, I have my percentage gain, my percentage capital gain, percentage loss, percentage capital loss. That's all I really need personally. And then I deduce my averages, the sum, the R sum or the dollar sum, right, for the month. And then I go over my biggest gains or my biggest losses, right? And also the month's win rate. So if I go down here, there's some months where my win rate, so there's some months where I had some good returns. These were good returns, right? And then this was a pretty flat month, August. September, nasty month, -6, 0% win rate. Then there's October, 22, 30% win rate. So, you know, month to month, things can change. You can have some really negative months. Here's another one, right? Minus almost 10R and 0% win rate, right? So horrible month. December, another rough month, right? So I also do a yearly panel. Here is my yearly panel. I'll go over my biggest winners for the year, my 5 biggest wins, my 5 biggest losses, my 2 best days, my 2 worst days, what I need to focus on for the next year to improve, right? And then my win percentage for the year, my average win percent, or my average win, my average loss, my average week, my average month, right? And then average percentage gain, average percentage loss, 2 worst months, 2 best months, 2 worst weeks, 2 best weeks, right? So this is all, and then I also do a little report, right? So this is all very important data to track. In conclusion, you need to track your data, right? Like a business, you need to know what's going on under the hood to even have any resemblance of having a chance, right, over the long term. So that's step number 1. Step number 2, there's a lot of things you can learn from your data, okay? There's a lot of advantages to analyzing your data, okay? So, there's a lot of insights where you can enhance, right? Like I was saying, Kelly criterion or different math, right? And then point number 3, you can make actions off of this data. So in my previous trade, the how to manage trades video, I went over, or well, how to manage risk or how to manage a trade, I can't remember. But in one of my previous videos, I had gone over the concept of selling at average R, right? So that's an example of how you can make an action around your data, a very valuable, logical action, right? It's mathematically valuable and logically valuable. So that'll be all for episode 8 of how to track trading data. I hope you've enjoyed this video. If you found value, please like and subscribe. Thanks for watching.